don't have a clue about the stocks and shares market, all the terms and all the lingos? Well, don't worry, stick around because in this video, I'm going to be teaching you about all the stock market basics you need to know. Welcome back to my channel. My name is Jason Lloyd, and on my channel we talk a lot about investing and financial freedom. So if you would like more content, then do make sure you subscribe to my channel and do turn on that notification bell so you're notified when I do release a new video on financing to help you. So as new investors, there is a lot of information that we need to know when we start investing, and it can often be very confusing with lots of different lingo and terminology that people use to describe what it is.
Just can't understand anything. Nothing makes sense.
But don't worry, if you are someone that is new, I'm going to be breaking down exactly what everything is. So hopefully by the end of this video, you will have a lot of knowledge and you will feel much more confident and you'll feel comfortable explaining to someone exactly what some of the terms are in the stock market that you need to know when you're a beginning investor. So there are only about 3 different calibers that we are going to be breaking down today in this video. So let's break it down, starting with number 1.
Stocks and index funds.
So the first thing that you need to know about stocks is that you can buy individual shares in a company, and over time the shares of this company may go up and appreciate in value, or it may go down and it will depreciate in value. And so as investors, depending on how many shares we own of a particular individual company, that is where we are going to potentially see those losses or those gains on our account. And something else to be aware of is that individual stocks may pay a dividend yield. So every quarter, we may actually get a payment received from the stock that we are holding. So let's say I had £1,000 in shares for an oil company such as BP. They may actually pay me a dividend yield of about 10% per year, which means I'm going to be getting either monthly or quarterly payments, which will make up that annual gross fee of 10%. Plus, I may also see those gains on the account if the stock itself does appreciate in value over time. So you may have heard the term diversification. Now, if you wanted to buy multiple companies, that is going to be called a fund, because you can actually buy multiple companies in a stock. Now, most funds are actually measured by different types of classification. For example, we could have a geographical fund, which could measure, say, different countries like the UK or America or developing countries. We then also have funds that are measured by profitability. So it could be how well they're performing, the top revenue. Then we also have funds that are measured by output. So it could be, for example, a fund such as gold, or it could be commodities such as oil and gas or electric. And these are the different types of funds that we should be aware of. This is where having a stock such as the S&P 500 in your portfolio would allow you to have individual shares in multiple different collections of companies. Essentially, it's like an index fund that measures the index of the performance of these 500 companies, because it is a spread of 500 different companies into one share. Now, this is a really good way to diversify our portfolio, because what it's going to mean is if we're investing into a fund, for example, like the S&P 500, where we have different shares of individual companies such as Coca-Cola or Apple, Microsoft, it would mean that we have diversified our portfolio and we have spread our wealth into different individual companies, but essentially it is one company because we are actually only investing in the S&P 500. And as long-term investors, I always think it's a really good idea to have a diverse portfolio, because obviously we don't want to put all of our eggs in one basket, because what happens if that basket was to break? And that is something that we want to avoid. And in my video, you may hear me talk about the S&P 500 quite a lot, because I do think as a new investor, it is something that you should always be aware of. The S&P 500 over the last 100 years has actually always seen a gain in the stock market of roughly an average of 9% per year. So let's just say I was a new investor and I was investing £10,000 into the S&P 500. I could actually expect to see over the last 100 years that an average of 9%. So I could expect to see £900 return per year, and that's just for the £10,000 I invested. Of course, if that then went up year on year, I could actually expect to see a higher return. This brings me to another term, compounding money, where we can expect to see an accumulation of wealth where we reinvest our profits back into more shares, and we create a higher percentage gain on our account year on year. Which of course is why the richest people in the world, such as Warren Buffett, are investors, because what they like to do is they like to compound their money over time, and they take their profits and they reinvest them into more stocks and more shares, and they compound even more money year on year. And of course, this is a great tip, because if we do want to have and generate a passive income, then this is something that we should apply to ourselves. Why not invest those profits back into shares and stocks so we can see an accumulation of growth, and we can also compound our money over time.
What a good idea.
Investing smartly and successfully.
Why didn't I think of that before?
Now, something to be aware of as long-term investors, we do want to see a return in profits on our stocks that we are buying in our individual stocks. So what we don't want to do is invest money and then think, actually tomorrow I'm going to withdraw all of that cash that I have invested, because this is the wrong attitude to have. We're long-term investors, which means we are going to put that money away for several years, hopefully at least 5 to 10 years, and we're going to see that nice gradual increase in our stock over time. Because of course, over time, inflation will go up, and so should the price of stocks. But there will always be falls and also rises in the market. And it's just about learning when we do see a drop in the market, knowing that there will be a recovery. Because of course, the stocks and shares market will always move up and down. But this is nothing to panic about, and it is normal. And we can take a look back at history. For example, the stock market crash in 2008, where we did see a big dip in the stock market. So this is where we can really see over history that since the 2008 stock market crash, things have recovered and have gone beyond where they were in 2008. And that, of course, is where we can expect to see a great return on our investments if we have invested our money into the right companies. So now that we understand a little bit more about stocks and index funds, I'm going to talk to you specifically about active funds and passive funds. And so a passive fund is where there is no interaction at all in a fund. So for example, there is only a profit or a loss, and that is all we will see, and it's a more organic and natural process where there's no interference. And so an active fund is when someone will selectively choose individual stocks and shares for you. They can also be part of an index, and that would mean that there is a fee normally associated with that level of service. Now we do want to be aware of charges, and I would say to avoid anything above 0.5%, because ultimately you always want to be thinking about your wealth and how you can gain more capital in your back pocket. So if we're paying out lots of money in fees, then we're not going to have as much profit to take in our back pocket. Now, an ETF is,
Oh, I know this one. It's an exchange traded fund.
is also another form of passive fund, because what would happen is it would go up in value or down in value throughout the day. But it's more granular, because an ETF means you can essentially buy it or sell it when the market is open, when you decide to do so. So we have talked about having an individual asset as part of a company, which is a share. We've also looked at index funds, and we have looked at ETFs. Now that brings us to our number 2 on the list.
So we're now going to look and talk a bit about bonds.
And so a bond is technically an agreement or a declaration to a company or a country where they are borrowing money and there is a fixed rate of interest. Now, if interest rates go down, that means that your money is worth more money over time. Now, the most common use of bond here in the UK is the premium bond, which is technically an agreement, a bond where if I was going to put in £100, I can actually withdraw that £100 whenever I wanted. And how I get interest is they will actually selectively put me in to win a certain amount of prizes or jackpots per month. But there is no guarantee that, of course, I will win these prizes. This is just ultimately by luck and by chance, like a lottery draw, but that is another form of investing.
I've won a hot tub.
But it is worth knowing that whatever money you do put into a bond may not be worth the same value that it is, say, in 5 or 10 years. And if we look back at history, we can actually see that £100 today was certainly not worth what it was in a value of 30 years ago. And so whenever we receive bonds, whether that be to a company, a country, or ourselves, even though we have a physical value, there is no guarantee of what we can actually do with that money. Which brings us to our number 3.
Who doesn't love getting their hands on a nice bit of cash?
Now, cash is not an investment. So if you think holding onto cash will make you rich, it will, but just not in the smartest way that you can work. I'm saying let's spread our wealth into different investments where we can see an accumulation of growth and we can really start to have an understanding on how to compound our money and generate financial freedom for ourselves and a passive income. Because of course, if we hold onto cash, it's not particularly investing where we can actually see a return. Now, I'm not saying throw all of your cash at the stock market. I'm saying let's be smart. Let's take a step back and look at what we can do to generate a higher return of profits and start to invest in smart choices. And of course, we know that £5 today is going to be £5 tomorrow. But with inflation rising between 1 and 2% per year, if we are going to hold on to that cash long term, then we can expect to see a decrease in value to the capital and the cash that we are collecting. So this is why it's really good to spread out that cash into multiple investments and different platforms so we are diversifying ourselves and we are investing smartly. Because of course, ultimately, I want you to be financially free and I want you to have the best source of passive income that you can generate for yourself. So you may have also heard of the word platform. Now, platform is basically the service provider that we are going to choose to go with, and that's where we're going to put our money and we're going to invest with that platform. And that's essentially what that word means. So hopefully now you'll be able to understand when someone says, which platform are you with? Or what platform provider am I choosing? That is what it means. And so there is something out there called a modern day portfolio theory. And this really is where your mutual funds kind of come into everything. So a mutual fund is where we can actually spread our wealth into different sections. For example, if I was to use an account in a portfolio in Vanguard, they may actually allow me to put a certain percentage into bonds and a certain percentage into stocks and shares. Now, really it's up to you what you choose when you are going to choose a mutual fund, whether you want it to have a high risk or a low risk. But the other thing to be aware of is our age and when do we want to retire. Now, if I was 18 years old, I might be able to afford to have a high caliber of risk. So I might be looking at a mutual fund that has a 100% risk element. Now, of course, over time, we may see those dips and also we will see those upsides. But long term, if I'm going to invest my money for at least 15 to 20 years, then we should see a really, really nice profit in our account, gaining a passive income and financial freedom long term that is going to allow us to hopefully retire early.
But I'm not 18 anymore.
But of course, we all start investing at different ages. So some of us could be 30, some of us could be 45. And really, it's down to the individual and what you choose to do with your money when you invest. And of course, when you start investing, it doesn't matter what age you are. It's about how you choose to do it. If, for example, I was 45, I might not be willing to risk what I wanted to risk when I was 18 years old. Therefore, I may choose a lower caliber of risk, which may be about 60%. So really, investing comes down to you and it comes down to what it is that you want. Now, of course, as we have talked a lot about investing, just a tip, if you are going to buy into a share, for example, like Apple, I always say try not to do more than about 5 to 10% because you always want to diversify your portfolio, as we talked about in the beginning, so you can actually eliminate a lot of those long-term risks associated with just putting all of your eggs into one basket, because again, if that basket breaks, then you're not going to have anything left to support you. Please make sure as well that you do all of your own due diligence and research before you take action on investing. So I hope you found the content of this video useful and it has inspired you perhaps to start investing smartly. If you do have any questions on the video, please do write below in the comments and I'll get back to you as soon as I can. And if you would like to open up in a trading platform, I recommend 212. They are a great trading platform for new investors and they actually give a free share up to £100. So I will leave the link below in the description and you can use my affiliate for that. And if you would like more information, then do check out this video right here because I have done a review on the trading platform of 212 and they are accredited with the FSCS, the Financial Trading Institution. So your money will be protected up to £85,000. And again, if you are from the UK, then you will get that free stock. So whatever you do, have a wonderful day and I'll see you back on my channel for some more information on finance to help you. Ciao for now.
I still can't believe I want a hot tub. I have no one to share it with.
But Jason, wait, I have more questions.